in terms of your commitment in attending these classes. Thanks, Brandon, for that. But very good afternoon, everyone. I'm hoping that your afternoon is going well so long. And I'm hoping that you have been able to recap on the learning units that we have covered so far. Learning about consolidation of a wholly owned subsidiary, partially owned subsidiary, and also understanding how you do your consolidation throughout the period. I'm hoping that you've been able to go back and do the exercises that we have done. You have added more exercises to hone on your knowledge that you are acquiring in terms of being able to compile consolidation. So very important, please note that you must please ensure that you complete your attendance register. So I'll just put up a link quickly for today's class, and please make sure that you quickly complete the attendance. It is very important that you complete the attendance throughout the day. I will keep reminding everyone in terms of making sure that they do compile they complete the attendance register, and at the end of the session, we're gonna have a link to a feedback form. All right, there. Sorry, we already have the attendance register put in. So please ensure that you complete the attendance register. So without further wasting time, for those that do not know where we are, I'm quickly going to try and map where we are so that everyone is able to follow and understand where we are. We are today working on learning unit 7. And we're just going to go, because these are very important matters that we are going to discuss today in respect of intra-group transactions. So I really prefer, before us thinking of tackling a question, that we are able to do all the intra-group transactions that you have to do for the syllabus. So you will note that for today, we're going to work on examples. Of course, there is a question 1 and question 2 that you have at the end of the learning unit. The only reason why I do not want to focus on them is mainly for one reason. It's because they are not testing all the 4 possibilities. So we will be doing each example relating to each element. We will talk through all that, but maybe what we can try to do is question 2. So let's see how fast we can be to quickly tackle all the principles around the intra-group transactions. And I'm quickly going to share my screen so that you can be able to follow everything that I'm going to be doing. Just quickly sharing. But as I am doing the sharing, if you happen to have any question, whether it's about what we're going to be covering today, or whether it's about what we have covered previously, please make sure that you shout, and I will be able to assist. I was just trying to see if there's a way that I can close many open things in my window, but it's fine. So today we're saying that we are working on learning unit 7. We are working on learning unit 7. What I'm going to do is I'm quickly going to open up a presentation. This was a presentation that was shared by your lecturers as well. It's also available in your MyUnisa. But I quickly want to touch on these aspects so that we can quickly touch on them as well in the study guide and be able to go and tackle question 2. So everyone knows that we've got very small time, so we must try to make sure that we unpack every element very fast. If you will excuse me, I just need to close all other open emails that I happen to have. So let's start here. Elimination of intra-group transactions. So what do we mean by elimination of intra-group transactions? So what we mean is when a company acquires another company and they are forming part of the same group, any transactions that happen between the companies needs to be looked at, because you are selling yourself as a group. The sales that you are making, the profit that you are making is all within a group. So it's like money cycling between the two, the group and the parent and the subsidiary. So it's money cycling between those entities. So these are the types of intra-group transactions that we will look at. It is the bills of exchange, it is the bank overdraft. So we've dealt with this before. So what is this in essence? It is when a company A and company B are on the same group and they provide each other loans. So another one will disclose the loan as a current asset. Another one will disclose the loan as a current liability. So that is the bills of exchange. And the bank overdraft will also work in the same manner. Revaluation of property, plant, and equipment, when another company within the same group, they sell each other items of PPE. Unrealized profit in trading inventories. This is the case when the companies sell each other inventories. So you look at the profit that was made. Remember, you've got two options when you are selling inventory. You can sell it at cost or at a selling price, which is cost plus markup, which for you to make profit. So that unrealized profit will have to eliminate in terms of intra-group transactions, as well as look at what has been sold to each other in the current year that we need to eliminate. PPE held by companies in the group. So we'll have to look at what happens when we deal with the revaluations and what happened when we have sold each other items of PPE. So the first one really becomes very basic. As I've explained to you, it's about one company holding an instrument of another company. So whether it's a debenture, whether it's a loan, but it's basically the offsetting of the two things. So we'll be able to do this on a question for you to get more context. Revaluation of PPE, it arises, they say the following two situations may arise. It's when at acquisition, you have been informed that there is assets and liabilities whose revaluation surplus has not been taken into account when you were calculating the fair value at acquisition. So in this case, they say when assets may be revalued mainly for the purpose of determining the purchase price without the journal being made in the subsidiary's financial records. So what does this mean is the parent buys the shares of a subsidiary, but we find out that part of the assets that are making up assets and liabilities or net assets being bought, there is an asset that was not revalued, no journal that was passed. So we need to pass it in a group financial statement. This means in a consolidated, pro forma consolidated journals, the asset of a subsidiary may be revalued in order to determine the purchase price, and an adjustment is subsequently made in the subsidiary's financial records. So You are just given additional information that the revaluation leads to capital gains tax, but this may be ignored for the purposes of this module. And then you are given this question. A Ltd acquired 80,000 in B Ltd on 1 January 20.11. Each share carries one vote. At that date, the land belonged to B Ltd were valued at 200,000. No adjustment was made in the financial records of B Ltd. Remember, B is a subsidiary. So this land that was valued at 200,000, no adjustment was made. Then you are told about retained earnings. Then you must consider all other assets and liabilities of B to be equal to fair value at the date of acquisition. Then you must draft the statement of financial position of A Ltd Group as at 30 June 20.4 in compliance with the requirements of IFRS. So basically here we do everything that we know of, that we have learned so far. The important things that I want you to take note of is you currently have long-term borrowings related to A Ltd, which is a payable. This becomes a payable, and then you've got the debit as a loan B Ltd of 80,000. So which means that one can be able to already see that these are the two transactions that are intra-group transactions, because A was provided a loan by B Ltd. That's why on B Ltd it will sit as an asset, on A Ltd it will sit as a liability. So credits, it's equity and liability. Debit, it's assets. So I want you to understand that part. So yeah, I'm not honestly going to do the whole thing, but I'm just going to try and find a way of explaining it, because on question 2 we'll be able to follow the same routine as well. So let's go back to the question. The land here at cost price, it's 140 for B Ltd. You are told that at acquisition on 1 July 20.1, land was valued at 200,000. So you can already see these differences between 200 and 140. So which means that the revaluation surplus would be 60,000. That's what the revaluation surplus would be, 60,000, and you have to account for this at acquisition. So you are told here the retained earnings was 46,000. So that's why if you are looking at an analysis of equity, we've got now a new item, revaluation surplus of 60,000. The second thing is the elimination of, I'm going to go to the journals. So this is the revaluation. And then you've got the elimination of the loans that are indicated to you. Everything else remains the same as we have discussed before. So this is the elimination of intra-group loans, which is the bills of exchange. And then you've got the revaluation surplus, which forms part now of at acquisition journals. And then you've got a question which tests the same principle of a revaluation surplus. And then we move on, we deal then with unrealized profit and trading inventory. So I want you to, when you've got time, to go through this presentation, where you are told that if A and B are in the same group, and A sells inventory to B and earns a profit of 1,000. In the same group, when you are doing the same set of consolidated statement, can X make a profit when it sells to X? So remember, a group is called X. A and B form a group called X. So the question is, can X make a profit when it sells to X? So which means these A and B are in the same group called X. So if they're selling each other inventory, can they make a profit? And the answer is no. They do not make a profit. So this means that you need to pick up now the unrealized profit and eliminate it in the group. So the example that is provided here, shows you how it is eliminated. So when you've got time, please go through this presentation to understand the basic example. But to go back to the study guide, so we've got an example here. Example 1. And definitely, I would really want to show the illustration of example 1 as well. So parent sells inventories to a subsidiary. So it's B purchases all its inventory from A at a cost price of 25%. Inventories on B's financial records amount to 20% at 1 January 20.8. Then you are given also total sales. So these total sales here become intra-group. This total sales becomes intra-group transactions, and this means we can immediately reverse the sales because you cannot sell in the same group. Even if it was A and B on their own, in their own separate financial statements, they can account for these sales. But when you are doing consolidated statements, you need to reverse these intergroup transactions. And here on B, you need to eliminate, because remember, this inventory was sold at cost price plus 25%. So you need to eliminate the 25% profit that has been made by A when it sold all its inventories to B. So when B purchased all its inventories, so I'm just going to go straight to the analysis of equity. So this is where this is shown. Income, this is where the elimination of intra-group sales are reversed. The elimination of unrealized profit, it's reversed. It touches both the opening and the closing balance. So we will be doing an example on question 2 that will definitely show both these areas. So you can follow these examples also when the subsidiary sells the parent as well. And then we've got the third scenario where a parent sells non-depreciable assets to the subsidiary. A subsidiary sells non-depreciable assets to the parent sells depreciable assets to the subsidiary sells depreciable assets to the parent. So it's very important that you follow these examples, the 4 examples, that will give you the context of the 4 things. So in the interest of time, what I'm going to do is we are going to go to page 150. And we're going to do this question. In full. So we're going to do this question in full. Question 1 requires a statement of financial position. So that's why I don't want to do that question. I would rather do question 2. Question 2 on page 150. This is the requirement. We must draft the consolidated statement of profit or loss and other comprehensive income, and the consolidated statement of changes in equity for the GL Ltd group for the year ended 28 February 20.8 in accordance with the requirements of IFRS. Ignore taxation on unrealized profits or losses. Do all calculations to the nearest rand. So That's what we are requested to do. So the information is presented in terms of statement of profit or loss for the year ended 28 February 20.8. You see gross profit, other income, we see expenses, we see profit before tax, other comprehensive income, we see statement of changes in equity, balances being provided. And we can pick up additional information that G acquired 80% of voting rights in LLTD on 1 March 20.5 for this amount. And you are told that this was what was in your assets and liabilities. Then you are informed of a machine that was sold, inventories that were sold, and you are further given information number 3. So what I'm going to request from you is to please read question 2 for the next 5 minutes. And then immediately we can begin to work on question 2. So please quickly read question 2 on your study guide whilst I'm just preparing the templates quickly. All right, I'm hoping that everyone has been able to quickly go through this question. So we'll move on. So we know that LLTD now is a subsidiary. Here is the information that we've been provided at acquisition. And the acquisition did not happen in this current year. Remember, this current year's financial, in terms of this current year, we have March 20.7 to 28 February 20.8. Remember, this is how our year is structured. So it's important that you always are able to have a timeline in terms of the financial year of a company. So in this case, we are told that G acquired 80% of voting rights in LLTD on 1 March 20.5 for 250. Then you are given the owner's interest was as follows. So the first calculation that we always do, it is to do the analysis of owner's equity of LLTD. So we know that here we'll always have a total. And from the total that we will have there, maybe I must just do this a little lower. So this becomes GLLTD space, and these guys are owning 80%. So here we will deal with an acquisition. Here we'll deal with since acquisition. The real reason why I always start here on the template or on not having these things pre-populated, it is also to help many students to understand what is the first step that you always must do. So if we have 80% owned by the current GLTD, it means that the non-controlling interest owns 20%. Right. So what is the information that we are given? Is we must not disclose this information in rent because it will be amounts. So just to put my headings in bold. So we are told that at acquisition, the owner's interest, which is LLTD, that we are doing analysis on, had a share capital of 100,000, and we are told that the retained earnings were 64,000, and we are told that the valuation surplus was 120,000. All right. So at acquisition, we can already make up that this is 80% of the price, and then NCI is 20%. Right, and then this gives you a total of 284,000, which is your asset and your liabilities, and the value for at acquisition becomes 227,200. So we know that here we'll either have goodwill or bargain purchase, but so here we will have consideration that was paid and NCI. So this is what we are going to have here. So we need now to go dig deeper and look at what is the consideration that was paid related to this acquisition of LLTD. So let us quickly go look. Yeah, there you are told that the acquisition was made for how much? 250,000. So we don't need to look. 250,000. Consider the carrying amount of assets and liabilities to be equal to the fair value thereof at the date of acquisition. What does this mean? It means if there was any asset that was not valuated properly at acquisition, then we would need to take cognizance of the revaluation that we would need to add at acquisition. So in this case, we only have consideration paid, all assets and liabilities are equal to the fair value thereof at acquisition. So this means that we will have your NCI at 56,800, nothing changes on it. So the difference, therefore, between the consideration paid and at acquisition is 22,000, and this 22,000 is equity represented by goodwill. Goodwill, and this is for a parent. It's not for a NCI. It's only for a parent. So our assets and liabilities are growing. We ended up having 306,800. So this is what happened at acquisition as things stand. Now, what we need to go now look at is since acquisition, what has happened. So we need to go and look since acquisition, what has happened since the first of so here at acquisition, which was equal to 1st March 20.5. So this was at acquisition. So we are now looking at since acquisition. So since this date of the 1st of March up to before the current year, what has happened? So where are we going to see this information? We will see it. So we are told here that we've got the retained earnings. So the movement after the acquisition becomes only about the profit or other comprehensive income. So that's what the movement becomes about. So in this case, we can see that on the 1st of March 2006. So let's look just above that. So we just have here the profit or loss for the current year. So I'm not worried about that. We'll come back to that. But here we've got an opening balance. Here, opening balance of 44,000 coming from retained earnings of LLTD. So basically what happens is this simply means that we now need to calculate how much portion in the past in terms of retained earnings was shared between the parent and the non-controlling interest. So in this case, we have retained earnings that have been given to us. Remember what has been given is 44,000. This amount that I've highlighted here at the beginning. Now we have to minus the retained earnings that we had from the beginning of 64,000. So in essence, what we are saying is you had 44,000 opening, sorry, as of now. So you deduct the 64,000 that you had, and then you are left with 20,000. So everyone, please note this 20,000 is a loss. But because we are dealing with what happened the previous year. The only item that we will use is the retained earnings to make any movements. We move on. We read information number 2. So information number 2 tells you on 1 December 20.6. Remember, this is outside the current year. This information that you are provided here is outside the current year, so it's affecting the prior year. So if it's affecting the prior year, this means you must adjust only the retained earnings because there's no other account that you can do an adjustment on. Inventories, similarly here, you've got a, quickly want to make these comments as I go along. And if you happen to have a question, please try to raise it now. This adjustments here relate to prior year. So these adjustments here relate to prior year. And then you've got here inventories, which are sold at a profit of 50% on cost price. And we had then the following inventories on hand. On 28 February 2016, this becomes opening inventory. And the one on 28 February becomes closing inventory. So the opening inventory will affect your retained earnings because you're adjusting unrealized profit. Your current year portion of closing inventory will only affect your current year movements. So it will affect your current year movement. So we're still going to calculate. So this should affect your inventory. So we're going to deal with that part of how it's affecting your inventory and also deal with the part where you are making the additional profit out of how you have made the sale. But we're going to do a calculation on that, but it affects the current year. This affects the current year. GLTD lent the sum of 150,000 to LLTD at an interest of 18% per annum payable annually in arrears. On 1 August, GLTD received and banked the check for interest for the month of February. On 28 February 20.8, the interest did not qualify for capitalization and was accounted for by both companies. So this means that you've got another company says interest paid. So interest paid will be paid by LLTD, and then you will have interest received, which will be made by GLTD. Right, I just want to quickly answer this question. Yeah, so what I mean by at acquisition, if there is an asset that was not measured at fair value at acquisition. So when you are purchasing another company, acquiring another company for a consolidation, you are purchasing assets and liabilities. So in essence, you are purchasing net assets. So the language that says assets and liabilities and net assets, it's a similar terminology. So if there was an item that was not equal to fair value at the date of acquisition, it means that you have to evaluate the asset or liability. But most of the case, the asset and liability, most of the case, it will always be land, non-depreciable asset that you have to calculate now its fair value. So, and then get to a revaluation surplus, and that revaluation surplus you would have to add now into the acquisition calculation that you are doing for goodwill. So in this case, you've already been provided with revaluation surplus, but in other case, you will not always be provided with this amount. So you will not always be provided with the revaluation surplus. So moving on. Sure. Moving on now. We try now to continue with our retained earnings since acquisition. We have already identified that there was a loss that was incurred before. So we look at what else could affect what happened before. So we can see that we need to work out the opening inventory because it affects prior year retained earnings. We also see that there was a transaction that we need to look at where we are told that on 1 March, LLTD sorry, I just need to where you are told that on 1 December 20.6, LLTD sold a machine with a carrying amount of 200 to GLTD. Note this happens after acquisition. At a profit of 50,000. So you have already been told that it's at a profit of how much? 50,000. It is the policy of the group to depreciate plant and machinery at 20% per annum on the straight line basis. So in essence, now what we have to do now, first thing, it is to eliminate what we call unrealized profit. And this comes from machinery. And it's given, it's 50,000. So we have to eliminate the 50,000. What am I saying? 100,000. You have to eliminate the 50,000. Now, I want to take back now, and I quickly want to find a page where we can now discuss this part of the depreciation. I am going to touch now on this just quickly. I just want to see if I've got a nice summary given on this part of all right. I don't see it very nicely put in your study guide, but what happens here is we have eliminated unrealized profit here for machinery. I'm also going to quickly do journal entries so that you can try to follow up everything that we have done. So so that you can be able to match it as we are doing it bit by bit and be able to follow it. So what happened here is we are reversing 50,000 profit that was made on the machinery. But I want you to remember on the books of GLTD, on the books of GLTD whom has received a machinery of 200,000. You can be able, GLTD is depreciating this machinery at 20%, which means that they are paying how much profit on this machine? 40,000. 40,000 that is payable, depreciation. They are charging depreciation at 20% and it becomes 40,000 per annum. But now you are told that part of this profit is unrealized profit of 50,000, which means that in the group's books, you are making a you are making less of a profit because you have got more expenses that you have incurred. So what do I mean by that? Let me quickly show you a quick demonstration. I need to move here. So I want you to look at this in GLTD's books. And then we're going to do this in LLTD's books. So ALTD, GLTD, and LLTD. So LLTD sold a machinery with a carrying amount of 200 to GLTD at a profit of 50,000. So in GR's books, when you are looking at the statement of profit or loss and other comprehensive income, you've got a profit, you've got other income, profit on sale of an asset, of 50,000. Please, if it happens that you're not following me, you must please immediately inform me. On LLTD's books, on a statement of financial position, we've got a new item called machinery. Is it machinery that was sold? Yes, machinery. So on the books of LLTD, you've got PPI item, which is made up of machinery of 200,000. In the same light, on the statement of profit or loss and other comprehensive income, you've got other expenses which make up depreciation, which your depreciation now is going to be, in terms of the calculation, is going to be 200,000 multiplied by 20%, and this is going to give you 40,000. And this gives you 40,000. So on their separate financial statements, on GLTD, you recognized an income of 50%. On GLTD, on LLTD, you recognized an PPE item, an asset of 200,000, and you've recognized a depreciation of 40,000. Now, if we were, now this is what now we are trying to reverse, because this is what we call an unrealized profit. Because remember, we are saying GLTD and LLTD is equal to GLTD group. This is what we are saying. So in other words, you cannot have GLTD group selling each other a machinery. So we need to reverse this profit that was made here of 50,000. We need to immediately reverse it, the 50,000. And then we need to also reverse the depreciation of 20% that was made on unrealized profit. So remember, year to year, up until the whole 5 years, you are going to sit with this depreciation of 40,000. Now we need to make sure that this depreciation is calculated correctly. So which means we need to eliminate depreciation on 50,000. So how do we go about doing that? We are going to say 50,000 multiplied by 20%, and then annually, we need to eliminate this depreciation. This depreciation of 10,000. This is now what we have to do annually. It is to eliminate this depreciation of 10,000 until the asset is realized. So which means 20% is also equal to 5 years. So which means that for 5 years, we need to eliminate a depreciation of 50,000, which is 10,000. And this means that our depreciation per annum is supposed to be 10,000 at the group view. When you are looking at the group side, your depreciation is only supposed to be 30,000 per annum, because that will be on the 550,000. Right. So I just thought there was something else. So this is supposed to be depreciation based only on this asset that was sold. This is supposed to be, so can I just ask if everyone is following what we are doing? Before I proceed, I just want to understand if everyone is following what I'm doing.
Yes, I'm good on my side.
Sure, thanks for that. At least I've got a confirmation that everyone now follows. So this is what happens on the separate financial statements. And now we need to speak about this now from a group perspective. So we have reversed this. No, I'm coming to that. We will answer the issue of the period. But the first thing that I needed you to understand is annually. Remember, this 20% is per annum. So annually, this is the depreciation that you must reverse. So we have to reverse this 50,000 as a profit. And the second thing that now we must do is to deal with the depreciation adjustment. Call it depreciation adjustment or realization of depreciation. So how do we go about on this? So now we go back to the information. We're picking up that now this asset was sold on the 1st of December. So what is the year end? It was sold on the 1st of December. The year end on this case would be year end would be 28 February 20.7. So now we need to look at how many months from December to February it is. So we can see that it is how many months? It is December, January, and February. So which means the depreciation adjustment is going to be made up of, in terms of the calculations. Remember, we've been told to show all calculations multiplied by 20%, multiplied by 3 divided by 12. So this becomes your depreciation So it's 50,000 multiplied by 20%, which gives you 10,000, multiplied by 3 divided by 12 gives you 2,500. Remember, this depreciation on the separate financial statement has already been accounted for as an expense on separate financial statements. So what we are doing on our side is we are adding it back because it was not supposed to be 40,000, it was supposed to be 30,000. So we need to add back this 10,000 annually. But now for this period that the machinery was purchased, you can only adjust for 3 months of the 12 months, which makes 2.5. So your retained earnings in this case would be made up of everything that is sitting in this box. So it's the sum of everything that is sitting here, which is making 67,500. So the only line item that we're going to move on now is the retained earnings. So the parent takes the 80% and the non-controlling interest takes up the 20%. And then we move now, we go to the current year. So current year, we know that now we're going to have profit for the year. So which means that now we need to calculate the statement of profit or loss and other comprehensive income. So that's what this is what now we need now to go through so that we can be able to get the profit that has been made for the year so that we can be able to take it. So let us quickly look what we have been given so we can proceed with the calculations. So for LLTD, the profit that we've been given is, so we do not have profit for the year, we do not have comprehensive income. We've been given 64,690. This is given on your statement of profit or loss that you've been given. So we don't need to calculate it because the subsidiaries information has been given. Now I want you to remember that we now have to do a depreciation adjustment, which is on excess depreciation that I've already shown you. And then we have to show that the calculation is 50,000 multiplied by 20%. Now for this period which we are in now in the current year, so which period would that be in the current year? This would be from the 1st of March 20.67 to 28 Feb 20.8. So this is what the current year is in this case. So this date, I'm just inserting for demonstration purposes. So current year, we've got this depreciation of 10,000. So what we're going to do is we're just going to do this so that we are able to do our calculations in here. So we've been given the profit of 690, and we know that we've got a depreciation that we must add back of 10,000. So your sum here, remember we are adding it back because it was initially deducted. So please try to get the signs correctly. We are adjusting it, the excess depreciation, which was a negative, now it becomes a positive. So you can now easily, must quickly just do this, freeze this part. So you can quickly be able now to move on and do your since acquisition, multiplied by 80%. And then your at acquisition, your non-controlling interest takes 20% of the profits. And this basically then is taking us now to the last part. So the last part is being able to add your assets and liabilities, which is your net assets. This is called total assets and liabilities. So this is going to be equal to this total here, plus this one, plus this one. Here we're going to have total, and we're going to have total. Acquisition stops there. So we are done now with our analysis of equity. Is there any questions from analysis of equity? No questions. So we move on to being able now to do the other items that we were requested to do. So now we're going to do a consolidated statement of profit or loss, and also statement of changes in equity. So quickly, now we're just going to add 1 and 1, 1 and 2, 1 and 2, and all those things, which is very now going to be very simple for us to follow. So let's look what we have here. We've got gross profit. Gross profit, because it's affected by C2 gross profit, because it is affected by this item where we are dealing with number 3 of selling inventories. So the inventory affects your cost of sales, and of course we do not do statement of financial position, so we're not going to be adjusting the closing inventory, but we now have to deal with how cost of sales would have been affected when you are dealing with your inventory. So here, this means that we will have calculation 2. Calculation 2 is gross profit. So we've got sorry. So we are told here GLTD sold some of its inventories to LLTD at a profit of 50% on cost price. So what has simply happened here in this case is the fact that the inventories that were sold to LLTD at a profit of 50%, and they are sitting in LLTD's books on hand. This means that the 210 has got a 50% markup that was made. The 315 has got a markup that was made. So what happens is, what we're going therefore to do is we're going to say remember it's GLTD's gross profit as given. Let's see how much was given. $484.80, and then we have to adjust the opening balance of the unrealized profit that GLTD made when it sold its inventory to LLTD. So we must now work out unrealized profit on opening inventory and also unrealized profit on closing inventory. The calculation is very simple because all we have to do now is to take the amount that we have been given, which is 210,000, multiply that by the 50% that we have been given. So we must take out this 50%. This is the formula in which we must now take out the amount that was made. And then on closing inventory, it's 315,000 multiplied by 50% that was made divided by 150. At any time that you have a question, please just stop me. And then here it's 315,000 multiplied by 50 divided by 150, which gives you 105,000. And then we've got LLTD, gross profit as given. $326,300. Yeah. So we can be able to total this. This is your total. But now what I want us to discuss is the opening inventory. Remember, it relates to prior year. So what you are saying is GLTD made profit from selling this inventory in the prior year, which means that you had higher sales, less cost, which means that you would have made more profit in the prior year. So now what we simply now have to do in following up this on our side in terms of the 70,000, we have to debit retained earnings and credit cost of sales. So in doing this, it means that we are reducing our profits that we have made in the prior periods. Now for the closing balance, what we have to do now, it is to increase our expenses. So the top one, we increase our income. The second one, we increase our expenses so that we've got lesser profit that we are making. So in the current year, the closing has got, you deduct the unrealized profit for the opening inventory, you add the unrealized profit on the gross profit. So I will try to quickly go through with you on the journals that have been drawn. I'm not going to do them. We're just going to go through them in the solution. So we've got gross profit here that has already been made on the calculations of 775,980. So we go and look and see what's the other item that now follows. The other item that follows is other income. So other income, it's made up of there you are given its interest received and administration fees received. So what we're going to do is we're going to add all of them together. So instead of me writing them again, they're duplicating what I'm going to be doing here. You are going to say 750 plus 12,500 plus 24,000 plus 12,000. So this gives you 84,250. But I want you to remember, when you were given the information, I illustrated to you that on item number 3, you are going to have items that are affecting so you've got interest paid and interest received from LLTD and from GLTD. So what does this mean is on the 1st of August 2018, remember in terms of the timeline, our year started on the 1st of March. So this interest agreement was entered into on the 1st of August. On the 1st of August 20.7. So which means that we now need to calculate the interest portion that was actually received by GLTD, and we need to take it out because we need to eliminate it. Remember, it's the same thing. We need to eliminate these two transactions. So we need to say here minus, and then we do a calculation of 150,000 multiplied by 18%, multiplied by how many months is it going to be to year end?
7 months.
Multiplied by 7 divided by 12 months. It's currently correcting my thing. Then the total gives you 68,500. But remember, yeah, maybe this is what I must do so that you can see everything. This is what we did. Text. So we move on. We see what is another item that we have in terms of the statement of profit or loss and other comprehensive income. We've got expenses. So we've got administration fees, auditors remuneration. So we call all that administration, admin expenses. So give it a bit of the space in between. So admin expenses. So what will make up admin expenses? It is everything. It is depreciation. Depreciation 158,000 plus 134,400. Remember now on depreciation, you've got that depreciation that you must eliminate annually. I've already calculated it. It's 50,000 multiplied by 20%. This is just for you to be able to see how we got to this part, plus staff cost 60,000 plus 8,000. Interest paid 28,500 plus 24,650. And here, now we need to minus. We need to minus now 150,000. The same thing that we did at the top, multiplied by 80%, multiplied by 7 divided by 12. Remember, we are eliminating already what we have already done. The whole interest paid will fall under finance cost. I apologize. This whole part will fall under finance cost. So we will have finance cost because remember this must comply with IFRS. So I'm going to demonstrate it here. The interest, you're going to do it on its own line item. Sorry, I missed that part. So we skip the interest. We look at auditors remuneration. Auditors remuneration is 12,400 plus 8,600. It's administration fees paid 12,000 plus 6,000, and all together gives you for everything now must sit as a negative 429,400 Then you've got finance cost, that is 37,400. Fine with it. This is 37,400. Let's just keep on indicating these movements. But for you, when you are sitting in an exam, please, these totals, for you to keep on carrying them, becomes a total waste of time. So it's wise that you don't keep profit before tax, that you don't keep jotting down the totals that I have just that I just keep bringing down. You can just have the items that you have written because there is no marks per each total. So we've got profit before tax, we've got income tax expense, so I just need to take, I just need to remember to take this. So that one can be able to see how we got to these calculations. Right? Income tax expense is going to be straightforward. It's given. You just add the two figures together. 141, 412 plus 64, 460, which gives you the amount, and then you've got profit for the year. And then you've got other comprehensive income. So let us look. We don't have anything under comprehensive income that's given, and nothing that is affecting the statement. Then we've got total comprehensive income for the year. And then we've got this nice part always that says total comprehensive income attributable plus of the parent and also to the non-controlling interest. Non-controlling interest becomes easy. We can reference to calculation one. Calculation one, this is where we calculated current year profit of how much? 14,938. So we just reference to that. Then we've got 14,938. And then the parent will just be 171,808 minus 14,938. Any questions so far? Because now we're going to move and work on statement of changes in equity. So statement of changes in equity, we've already been provided, so we can see that we are dealing with share capital. We are dealing with valuation surplus. And we are dealing with retained earnings. Then we've got a total column. and then we've got an NCI, then we've got a total column. So please don't forget to complete the attendance register. There's also a reminder on that. Please do not forget to complete it. What am I doing wrong? Right. So here, when we are doing our statement of changes in equity, we will always have a balance. Call it also opening balance. 1st of March 20.7. So some of these balances are given, some of them are not given. So let us go figure out what is given and what is not given. So share capital, remember, one of LLTD is eliminated at acquisition. So we've got share capital that is remaining. It's going to be only 200,000. It's only going to be 200,000. The valuation surplus, we've got only 80,000. Remember, the other one is going to be eliminated. Retained earnings, it's 44,000. Remember that now we have to go and look how we can combine these two retained earnings. So how are we going to combine these two retained earnings? Is we're going to have that of a parent, 224,690 minus at acquisition, minus, we're going to come here on the statement of profit, statement of analysis of owner's equity. And you can see here, we had a 54,000 that was attributable to a parent. And the second one, we will also take as well quickly. So we must first take 54,000. We are on statement of changes in equity. This becomes minus 54,000 of the losses that you have made. Right, there's another part that we still need to deduct now. So I just want to quickly check with you. What else are we identifying in terms of every information that has been provided to us? What else can we pick up? Remember, there is also inventory of 70,000. Inventory of 70,000. So this particular block, I'm going to make it yellow. No, it's fine. I don't need to make it yellow. I can just quickly show the calculation of this part here. So you've got retained earnings of a parent, 224,690. This is for GLLTD. Then we had since acquisition. Here, in terms of our calculations, since acquisition here, where retained earnings were how much? 54,000. So we've got that 50,000 as well. 54,000 relating to a parent. This is on analysis. Maybe let us say calculation 1. Analysis of equity of LLTD. Then we also had opening inventories that we needed to adjust in the books of GLTD because they made a profit of how much? 70,000. So that's why we have retained earnings of 100,000. For those that wanted to see how this figure became how we came to this figure of can everyone now follow how we got to that figure? Right? Then your NCI, you take it on your analysis of equity. Calculation 1. Remember, your analysis of equity at this stage would be 56,800 minus 13,800. So 56,800 minus 13,500. So that's what your statement of changes in equity would be. I need to remember now these balances. 56,800 minus 13,800, which gives you 43,300. So the next thing that we look at is something called changes in equity for 20.8 in the current year. So we've got profit. So we've got total comprehensive income for the year. And then it's divided into profit for the year. As well as other comprehensive income. So one can already see that the biggest part of this thing is the opening balances. So these are the complex opening balances that you definitely have to get right. This part of the opening balances. So let's quickly move on. We don't have comprehensive income, but I'm just showing you that it comes here how we would have how the information would have spent out. So this is just for demonstration purposes. So profit for the year only affects the retained earnings portion. So we go look at how much profit was made in the current year, and it's quite straightforward. It's this 156,800 by a parent, and the non-controlling interest is 14,000. So this is quite straightforward. Since now we have all these items, we can just go now and take them. And we do not have any other item that we know of. So we're going to have closing balance 28 Feb 20.8. And then we are done with the required. So we're just gonna now go back now and reflect if we have covered everything as per the required. So let us quickly look what was required. We were required to do statement of changes in equity, done. Statement of profit or loss and other comprehensive income, done. Is this in accordance with IFRS? Yes. You can see the statement of changes in equity. It's presented by function, so it meets the definition of IFRS. Statement of changes in equity meets the requirements of IFRS. We have shown all calculations to the nearest rand. So we've basically done everything that we were required to do in terms of the standard. So quickly from your side, just want to yeah, I'm not sure. Yeah. All right, I'm not sure what happened now there. It's just technology. Something just messed me up there. So on your side, I just want to check if is there any questions from what now we have just now covered today? Any questions? There must be a question. What we have covered today is definitely not an easy thing unless you have already mastered it on your side. I'm not sure. I am copying the evaluation sheet. I'm copying the evaluation sheet for your completion for today's class. Yeah, thanks a lot. September, you are noted. Andiswa, you are noted. I don't know what's happening. You guys are noted. Thank you very much for that. Of course, if there are questions, I'll stick around. So what I will do is I'm going to put on the questions that we have done today. And please note, one of the things that I've not shown you, but it's something that you can be able to quickly follow on your side is in terms of the solution, you can be able to follow these pro forma channels. So this first one is elimination. And then if you follow these channel entries, it will also help you to follow what we have done on our side. So it will help you to be able to follow everything that we also did on our side. And this one, if you've got questions, please feel free to put any of your questions on the chat on this link. It's monitored. As long as you put it to my attention, I'll be able to come back to you. So it's important that you try and do this thing on your side. So the next class that we will have, it's on the 23rd of September. On the 23rd of September, and it will be at the same time from 4 o'clock. The next class is on the 23rd of September at the same time. So please, if you've got questions, just put them here. I will be able to respond to them anytime when I come back and see the notifications that I have. With those words, ladies and gentlemen, thank you for today's attendance. Please do not forget to complete the feedback form. However, I will be available for a few minutes for any questions that you may have. And please note that on the next class, we are going to be building on what we have learned today, and we will be looking at the treatment of dividends during the consultation. So we'll first deal with the ordinary share dividends, and then at a later stage, we will work on the preference dividends. So thank you very much for today. Please, I will be posting the solution that I have done so that you can be able to access it on your side. Then we can continue the conversation on the next class. Thank you very much for today.